Investors and traders, welcome to the channel Market Chart Pattern. Today we'll be taking a look at the major US stock indices, but today we'll be starting in a slightly different manner. This video is for educational purposes only and it is not a financial advice. So we'll actually start today's video in which we'll take a look at the major US stock indices that we follow by actually taking a look at the bond market. So what we are looking at is a daily chart of the different um, uh, treasury notes, and we also have the long bond here. So I'm using the micro contract here because I find it as an easy way to represent the information that we are looking at. So what we see in the yellow line, this is the 2-year treasury note. Then what we have in this cyan color is the 5-year treasury note. The blue line is the 10-year treasury note. And then finally we have this yellow line, or rather orange, which is the 30-year long bond. And on the right hand side, what we see is actually the yield for these instruments. So what we are looking at is in this orange line, what we see is 4.946, almost 5%. So this is what the rates are for the 2-year note. And today we had the Chairman Powell testimony, and he did mention in the testimony, made a reference to the rather hot CPI data which has come in the month of January, and perhaps that has led to an expectation that in the forthcoming Federal Reserve FOMC meeting, perhaps there could be a larger than expected interest rate hike on the play for the Fed funds. So it could be um, 0.5%, which is 50 basis points. And in the last meeting, they had done 25 basis point. So that could be one reason why we have seen some sell-off in the equity markets. So the key thing to note here is looking at the structure. So Friday, 3rd of March, look at the jump between Friday and the 7th of March. So watching intraday on the 7th of March, the rather 6th of March, the equity market has actually opened quite positive and they rallied, but towards the noon, that's when on the S&P 500 we saw a double top formation, and then there was a third attempt to take the highs out. Market was unable to do that, and then we had seen a sell-off. So one of the key things that I want to point out in this is look at the shorter end 2-year note yielding 4.94%, almost 5%. This is market anticipating that perhaps in the forthcoming months, the Federal Reserve might have to be even more aggressive in their rate hiking and could increase their Fed fund rates, um, perhaps 5% or even 6%. That's the kind of expectation by the looks of it. But we don't know what is likely to happen. But what we need to pay attention to is how the steep and quick the rise in the yields have been. Also, one thing I want to point out is if we look at since the beginning of the February 2023, this has been a steep rise on the shorter end. Also, we can see for the slightly longer duration notes and bonds, there has been a rise. But the interesting thing is that we have the shorter end yielding higher. Then towards the middle, we have the 10-year note, and the long bond, which should be yielding the highest in normal periods, is actually yielding only 3.89, relatively speaking, and the 10-year 3.98 and 5 years 4.28. So guys, this is yield inversion. So usually a yield inverted yield curve is a is kind of a warning sign um, for a downturn in the economy, in other words, a recession. So this is what we have to pay close attention to. Let's also take a look at going back a little bit further. So this is going back in July of 2020. This is where we can see that the 2-year treasury note actually started to increase in its yield quite aggressively, and look at the 30-year note that began to actually lag in terms of its rise in the interest rate. And then finally we were also looking at the 5-year taking over the 30-year, and then 10-year taking over the 30-year. So it went through a period which is known as the hump in the yield curve, where we could have a situation that the securities which have got maturity in the middle, they actually begin to yield higher compared to the long end, which is the 30-year long bond, for example. So that was kind of that situation. So let's go back a little bit, and back in 2021 perhaps, and we kind of see what when things were kind of a little bit normal, what it looked like. So what we see here is going back to 13th of August 2021. Right at the top, we have the 30-year long bond. Then we have the 10-year note in blue. Cyan is again 5-year, and then the orange is the 2-year. So look at the what the what the 2-year was yielding back then in August of 2021. 0.214%. That was the interest rate, and look where it is now, 5 years. Sorry, excuse me, 5%, almost there. So how big, how much things have changed in little over 1 year, well, 1.5 years actually. Um, so that is something which we have to keep in mind, and the rate rises have been, in terms of acceleration, really, really aggressive, and that's why we have seen the equity markets peter out quite a bit. So this is what a normal yield curve would look like during normal growth periods, and where we have a kind of a smooth curve, upward sloping. And of course, for a longer duration bond, the investors would want to have higher yield because there is more risk involved in terms of the duration. So that's why typically a long dated bond would, or a note would, have a higher yield associated with it. Also, the kind of situation which we are in, one has to ask a question that if one has a pot of money and they need to put it to work, and you have a choice between bonds such as the treasury bonds, which are the risk-free instrument, versus risky assets such as equities, particularly those high growth kind of equities, where there is a business model which is producing revenues but unproven profitability. So now, if you have a choice, the investors could perhaps in a situation like this might actually prefer to put the money in a risk-free asset which could be yielding 5%, uh, comparatively speaking to a risky asset such as an equity of a high growth stock with a good amount of revenue but unproven profitability. So that's why we could see these Nasdaq kind of stocks, high growth stocks, um, unproven profitability yet, perhaps a good model, good revenue generation kind of tech stocks could see a perhaps significant pullback, which we have already seen Nasdaq pull back a lot, comparatively speaking, and then it went into a situation where actually Nasdaq began to lead over S&P 500. We have discussed that on our channel in our videos. However, with yields rising so much, we could actually go back to what was happening before. So let's go back to our um, indices. So let's take a look at ES. So let me make this a candle chart. So this is the daily chart of S&P 500 futures. Here, guys, what is really key is this level, 39.46. That's where we had a combination of confluence of patterns and Fibonacci ratios come together. There's a possibility if this low gets taken out, especially particularly on two consecutive closing basis, that in fact we might be looking at a structure which is an ABCD to the downside. So for example, like this, with a target somewhere around 3800, and going below will actually, for us, the way we have been looking at the market, we'll begin to view the market in a different way. So more on the bearish side, and the upside targets which we had, which we still have for now, we'll probably have to remove those. And what we might have seen here is basically a double top formation right at the structure and 78.6% Fibonacci retracement. But again, this has yet to be seen. We have to see that the whether this support level gets broken or not. With the 5 year, with the two, excuse me, the 2 year yield being close to 5%, I wouldn't be surprised if there is some pressure on the yields tomorrow towards the downside, and that might help the equities as well. But we'll have to see. Who knows what's going to happen? Let's take a look at the Russell 2000. So this is the small caps. So the small caps are actually more sensitive towards the um, interest rate sensitivity because of smaller companies, smaller operations. So what we had seen is actually a beautiful ABCD pattern formation here, and then what we had seen is a pullback since the beginning of the February. And remember this 2nd of February 2023. And if you go back to the beginning of the video and go back and have a look at the chart for the yields, and what you will see is that's the point where the yields actually started to rise quite aggressively, and then we have seen actually stocks pull back. So here, this is the key level of around 1870 as the support. Just like S&P 500, we have to watch this. But this index is actually already testing this, so the price is pretty much already there. So we might actually be able to get a better clue from the uh, small caps, perhaps, if this support gets taken down to the downside, comparatively speaking to S&P 500. So we have to watch this, and that's just going to change the way we are looking at some things. So going back to NQ. So NQ, similar kind of story, and we have seen the ABCD completion here. In fact, the index was stronger, and it actually went higher, and we had expectations perhaps it'll just move higher a little bit. We had a upward target for that. Price hasn't done that so far, and it pulled right into this support, which was the 38.2% Fibonacci retracement of the lows from 13th of October 2022. And then also we have this 61.8% Fibonacci retracement from this low here. Now, it is just like the S&P 500 and also the Russell 2000. It's really important that this low is held. If it is not, if it gets broken to the downside, then just like the S&P 500, we could be looking at a situation of a um, downward move towards the 1100 level, so 11,500 level, as the ABCD towards the downside. Let's take a look at the Dow Jones E-mini here. This index actually never really did that ABCD here, which we were expecting, and a double top here. And in fact, this index had been stronger comparatively compared to S&P 500 and also the Nasdaq, because it just retraced to about 38.2% Fibonacci retracement, and then it's just been in a trading range. And what we are looking at is here on the 1st of March, beginning of the month, we had seen a retest of the lower boundary of this trading range, and then the price moved higher. Things were actually looking good till the last Friday, and then on Monday, it was a good start, but then pulled back in the afternoon session. And today we have seen a strong pullback, so the price is likely to go and test this because of this strong bar. And then we'll have to see whether this actually might be a breakout if it begins to move lower towards the lower range. We'll have to wait and see if that situation will take place. We are also watching the other indices like the Russell 2000, the support level there, the S&P 500, the key support level mentioned over there, and the NQ 100. So that's the Nasdaq 100 index and the key level for support over there. So we'll have to look at all these things together to get a big picture along with what's happening in the bond markets with the yields to make an assessment of what is likely to take place in terms of the movement for the stock indices. So this is what we are watching. The video is getting longer. Apologies for that. If you like how we look at the market and how we do our analysis, then please do subscribe to the channel. Just one thing before moving, let's take a look at the dollar index because it's really important. With the yields moving higher, that is actually a good thing for the dollar strength, and this is what we have seen today. Look at the dollar. It's been really straight right into this ABCD pattern we were looking for. So what we have, guys, here is I did a video about a week ago in which we looked at the forex currency pairs, as we always start by looking at the dollar index, and we have this zone of 105.55 to 106.07, which is 38.2% Fibonacci retracement. So today this first target has been actually met, and perhaps the price is moving into this zone. It could actually move all the way to 38.2% Fibonacci retracement. Around here, we are expecting the dollar to go into resistance, which could also mean perhaps, if the dollar pulls back, which looking at the bond markets, perhaps there's going to be an ease on the rising yields. So the yields also begin to fall, which would actually be better for the stock market. Now the fall in the yield will have to take a look. Maybe it will fall for some time, and then longer term maybe they begin to rise again. But for now, this is what we are looking at for the dollar, and then we'll keep on watching the yield situation and of course the analysis which we do for the stock market. So again, guys, if you like our analysis, how we look at the markets, then please do subscribe to the channel. Also hit that like button if you like the video. That just tells me that people find my videos of value from an educational perspective, and just gives me the confidence that I just should be producing more videos for educational purposes. Excuse me. So thank you very much. Good luck and good trading.